When it comes to the RBA and how equities are reporting, it feels like Aussie stocks are finally getting some love. Is the risk of tightening already priced in?
Look, I think the investors at the beginning of the year was very, very worried about this inflation risk and tightening and all that. We saw the bond yield move and anything. But our view is that the bond yield move is really just a normalization. It went way too low. And what's happening in terms of inflation we saw in the US is more of transitory, if anything. We have yet to see evidence of a longer-term structural impact of a higher inflation. So, if anything, at this point, our view is that it's pretty strong for the equity markets, just given, usually this environment reflects a very strong demand environment as well.
So where are you finding opportunities and I guess bargains in this environment?
Yeah, look, that's interesting. Everyone keeps saying that, equity market look expensive, but it's not. For some sectors, yes, the valuation is a little bit stretched. That's why we saw some of the sell-off across the growthy and tech sectors. But look, if you look at everything else, most of the companies, cyclical companies that's exposed to economic growth, they are experiencing double-digit earnings upgrades and growth over the next few years since they just recovered from the COVID. So for those sectors, I think the businesses actually look very cheap on a 2-year view. So the thing for investor in this environment is to remain agile. You've got to buy those businesses that have the earnings growth. At the same time, don't completely throw out the growth end simply because because they are the structural winners over a long period of time.
Well, we have seen tech in Australia very much under pressure. The clear sectoral laggard on the ASX 200, the tech index down more than 12%. Now, with the RBA expected to take on a less dovish tilt, how are you differentiating when it comes to growth stocks?
Yeah, look, our view of the growth stock is that just as they sold off, you should begin to build your position. It's important to find the growth leaders, so the innovators of the sector and the leader of certain category, because our view is that their eventual addressable market is way bigger than many of investors' expectations. So as we have seen the earnings being upgraded for those businesses, so our view is that use this volatility as buying opportunity, because in 5 years' time, some of those businesses will be so much bigger, and the growth that will be delivered in 5 years' time will be incredible, versus some of those cyclical names where, you're probably taking a more 1 or 2 year view simply because the earning will recover from the COVID levels.
So do we see a risk of that cyclical momentum peaking as there's a shift in spending from goods to services? You just outlined that 1 to 2 year time frame.
Yeah, look, I think there's a bit of commentary now talking to potentially those inflation indicators peaking. Our view is that in the next few months, potentially in the US, the inflation number potentially could be still very, very, very high, simply because of the stimulus checks combined with the bottlenecks. So the commodity prices perhaps will be supported over that period. So short-term inflation prints will potentially still be strong. But for Australia, I think, we're reasonably balanced. We haven't got the big stimulus check that's been rolled out. If anything, some of our job keepers being wind back. For Victoria, we've got a little bit of stimulus just to support the latest lockdown. But I think we're much more reasonably balanced. And even though RBA may be less dovish, but the interest rate is not going higher, within the next 12 to 18 months. And they will continue to support the longer ends, to keep that yield low. So, with that sort of condition, equity market is looking very strong, especially the Australian equity market.
Now, we are seeing Australian corporates speak of margin pressures that are emerging from higher input costs. Under what circumstances could this be a headwind then for earnings, and which sectors perhaps could be the best cushioned?
Yeah, that's a really good question, actually. We have heard a lot of those corporates spoke at a lot of those conferences more recently. Many of them, over 30% of them, have talked to, the cost pressure that's coming through. Our view is that, corporate Australia remain well positioned on that basis, simply because we're pretty lean. We've been cost cutting over the last decade or so, and our balance sheets are very strong because of COVID. A lot of companies have raised equity. So the ability to cushion the short-term, disruption and short-term high inflation because of the border closure, the labor, the material, and the like, I think they can do very well. And in terms of demand, I think the demand is actually pretty strong within Australia. Consumer spending, corporate spending, in that sort of environment generally bode pretty well for, corporate earnings. We sometimes actually see for certain stronger businesses, you see margin expansion on that front. So, so they're positioned very well, the Australian businesses.
Feels like it must have been the last time that we spoke when we spoke about trade wars and political risks. Is that still on the radar for you? Because it seems to have, that risk seems to have receded in conversation lately.
Yeah, look, I think that you're absolutely right. So they receded from the headline, but the undertone perhaps is still there. For a global investor, these kind of risks, we call it the tail risk. So if things go wrong, it can create a lot of disruption for the global markets. At this point, it's sort of simmering in the background, and we kind of hoping that it won't pick up. But for an investor, hope obviously is not a strategy. We always tend to run a portfolio that's more balanced and keep some of those risks in check. So for some of the sectors that's very exposed to that sort of trade space, you do have to watch your exposure.